Greetings traders and welcome back to another survival guide. Chris here bringing you some more information, and today that information is going to be all about the CCI, that is the Commodity Channel Index. This is an indicator that's a momentum oscillator that can potentially help us better identify overbought and oversold scenarios when read correctly. So we're going to talk about exactly what the CCI is, as well as how to identify these overbought and potentially oversold scenarios. And before we do that, the first thing that we need to do is just put it on our charts. So let's go ahead and go towards the top center and click the Show Indicators Options button on the Finamark platform. After we do that, we need to add a new section because the CCI is an oscillator that is listed below price. It does not directly overlay price. Now that we have the second section, if we click on the second section, scroll down the center column to the C's, we'll see Commodity Channel Index, give that a click, return to our charts, resize it down a tad, and now we are good to go. So without further ado, let's dive on into that material, and while we're going through these disclaimers, please click that like and subscribe button down below because it allows me to keep coming out with these videos for you guys. Here we go. The Commodity Channel Index. It's been around for some time and it is very, very popular, but let's start off with what it is. We briefly got to look at how it looked on our chart. Here's a picture on the right-hand side, just in case you already forgot. But the Commodity Channel Index is a momentum oscillator that helps determine when the traded asset reaches an overbought or oversold condition, potentially speaking, if we analyze it correctly. It is used to better assess the direction and the strength of a trend, as well as to spot reversals by traders and potential market extremes. The CCI indicator was developed by technical analyst and mathematician Donald Lambert and was introduced in the Commodities magazine in 1980. As the name suggests, the indicator's initial idea was to help increase trading efficiency in the commodities market. It did that by mitigating timing challenges associated with the entering of cyclical and seasonal markets. At the time, this was a significant problem for technical traders as they struggled to adequately forecast seasonal market changes and to take into account the cyclical events resulting in the price fluctuations. Thanks to its efficiency over time, the CCI indicator became a favorite tool by traders to use in the equity and the forex markets. But today, now the CCI is seen in many markets. Just about any type of any vertical, we're seeing the CCI used. If you can chart it, the CCI most likely can be applied to it. Most use the indicator to determine their entry and exit points, or when to jump into a trade, or potentially when to avoid a trade entirely. It also helps traders identify whether they should add to an existing position. The CCI helps traders by achieving this through the process of comparing the current price fluctuations in the traded instrument with the historical ones. On the graph, the indicator is plotted as a line with a box that fluctuates between -100 and +100. For those of you that were dying to look at some math today, well, here you go. This is the formula to calculate the CCI. Now, once again, the calculation is done by the indicator for us, so we don't necessarily ever need to do this, but I am a big proponent on making sure that we understand how the indicator we're using works. So that's what we have here. If you're interested in recording this, I recommend pausing the video and copying this mathematical formula down. So the methodology behind the calculation of the CCI is relatively simple. The first thing that we do is we define the periods that we want to analyze. Usually 14 periods are the default, so that's normally what the CCI is going to be analyzing. The fewer periods we analyze, the more volatility we're going to see. If we see a higher period setting, like a 21 period setting, we're defining a smoother aspect in that volatility spectrum, so it won't be nearly as volatile. The next thing that we need to do is track the high, low, and close for each period. That way we can come up with the typical price value. We will then compute the moving average of the typical price, and to do that, we're going to sum up the last 14 typical prices and divide them by 14 if we use the 14 period moving average default setting. Then we're going to calculate the mean deviation for each period based on the formula mentioned that we were talking about. So if we take a look at this formula, that's going to be our roadmap. We're going to sum up all the values and then divide them by 14. And that's essentially all there is to it. But once again, don't panic if you aren't good at math or not interested in doing math, because the CCI indicator is doing exactly this for us. But at least now you know exactly what it's doing for us. To interpret the commodity channel index, it's important to understand that it represents the difference between the current and average historical price change for a particular security. High positive CCI values indicate that the current prices are above their average, and this is a sign of a trend strength. Low negative indicator readings suggest that the prices are below their average, which is a sign of market weakness. Traders can choose to use the CCI as either a leading or coincident indicator. When used as a leading indicator, the CCI helps recognize overbought and oversold market conditions that might lead to a mean reversion reversal, as well as a bullish and bearish divergence, or even potentially it foreshadows some type of momentum shifts. On the other hand, when we use it as a coincident, the CCI signals the emergence of uptrends. When we have surges above the plus 100 or downtrends that are dipping below the negative 100, these are examples of strong trend confirmations. 70 to 80% of the time, the CCI will move in the range between the negative 100 and the positive 100. However, during the rest, that 20 to 30% of the time, it will be outside of those levels, which will indicate an unusual strength or potential weakness in the current market environment. Such scenarios are considered a signal of a potential extended move and filters for the current bullish-bearish market direction itself. When the CCI ranges over the 100 mark, it is considered favorable for the bulls. And when it's moving below the negative 100 mark, it is considered a bear signal. In the general case, when the CCI moves from negative or near zero territory to surpass to the 100 mark, it is usually considered an indication for the beginning of a new and strong uptrend. So if we see it go from the bottom to the top, this is usually an indication of a powerful bullish trend emerging in the market from a previously bearish marketscape. And of course, the opposite holds true. If we watch the CCI travel from on top to down on bottom, we are on the lookout for a potential bearish trend thereafter. Spotting overbought or oversold price levels is another way traders use the CCI. It's based on simple logic. When the indicator is above 100, positive 100, the price is above its average. When the CCI is below negative 100, it is currently below its historical average. Alternatively, zones over the plus 100 and below the minus 100 marks indicate those overbought and oversold levels. When we're over 100, we're considered to be overbought and we're expecting some type of mean reversion. That means we're expecting the market to move back down towards the historical average because it is currently experiencing an abnormally high degree of buying prowess. When we are below the negative 100, the same logic applies, just flip the other way. When we're below negative 100, we can couple this with a read that the market will ultimately be looking to move back towards that historical average at some point because it does not spend the majority of time at or below the negative 100 mark or at or above the positive 100 mark. So we can trade this with the expectation that the market will be sucking back in with the coupling of price action. Another strategy that traders employ with the CCI is by paying attention to the divergences between the direction of the CCI itself and price. This means that the CCI is going to be going one way, but price is looking to be going the other. This is a divergence because they are diverging in their paths. They are no longer mirroring each other. The general accepted theory in this case is that price will ultimately resume in the direction of the CCI. So in the case of the divergence that we have listed here, we would be expecting to see price resume to some bullish state, which it did indeed do. This is because the CCI was rising while price was falling. falling and something has to give. This can happen the other way around as well. If the market itself and price action was rising but the CCI was falling, we would want to be on the lookout for the market to fall. Now, it's important to keep in mind that the divergence strategy is not a robust strategy by itself because it never properly identifies an exact entry point. The divergence can last for an extended period of time. Instead, when we notice the divergence, it's important to be aware of it as a foreshadowing of what's to come and make sure that our trading strategies are in line with what is possibly going to happen. As with all indicators, there are going to be advantages to them and there's going to be potential drawbacks. Let's start off by taking a look at the advantages that the CCI particularly likes to offer. The first is the fact that it works in a variety of markets. When you hear the Commodity Channel Index term for the very first time, it's natural to think that it's designed to work in only the commodities markets. But the truth is, we can apply it to equities, forex, futures, it just doesn't matter. The CCI is just a solid all-around indicator that does well with any charting style. The important thing to note is that the CCI should be adjusted based on the instrument that we're measuring's historical volatility. The second advantage is the fact that it's easy to comprehend, even by beginners. The way the Commodity Channel Index is designed makes it very easy to use and interpret even by beginners. All we have to do is adjust the CCI to the number of periods we want to analyze, and we're off. Once we do that, we are ready to go by using the CCI to give us those overbought and oversold readings like we already talked about. And the more we use it, the better we'll be able to spot the potential fakeouts and the potential juicy signals. The third advantage is the fact that it's a very powerful indicator. The CCI indicator can inform the trader about various market developments, including both those overbought and oversold price levels, the divergences, and even emerging new trends. The fact that it also provides insight into the price momentum and its strength makes it one of the most complete technical trading indicators out there. Now we'll cover the potential disadvantages, and the first is the overbought and oversold levels are indeed subjective. Due to being an unbound indicator, the CCI can't guarantee that when it drops below -100 or climbs above +100, it is a fair indication of an oversold or overbought market by itself. These are levels that are going to be dependent on being reached based on the period that we have the CCI set to. So we do need to get comfortable with adjusting the settings of the CCI and making sure that when the market has reached these levels, it has responded accordingly to how we're anticipating and using it. Number two is that it shouldn't be used as a standalone indicator. This can be said for basically every indicator out there, but it was important to include as well. And this is just the concept that using price action to sum up the concept of a buy or a sell being entered into the market on the basis of the CCI alone is a very nice layer of confirmation to add to our process of using the CCI. And number three is it doesn't take news into account. And once again, most indicators don't do this either. The fact that the CCI doesn't take news into account means that if it is measuring around a particularly volatile period that was caused due to news, it might skew the results of the CCI. So we need to take into consideration what's going on in the markets and always be aware of the news. So the CCI can be summed up as a universal tool that can potentially provide those overbought and oversold scenarios on top of potential market direction derived from the divergence or help us in the way of spotting emerging trends. It's a very useful tool. I strongly recommend checking out the CCI indicator if you have not used it already. It's something that can be very powerful, especially for those of you that are looking to develop your own strategy and haven't quite found one that fits you yet. When used in conjunction with outside price action, it's a very powerful tool. But until next time, folks, thank you for joining me as always. Please do me a favor and click that like and subscribe button down below, and I will see you in the next one. Cheers, folks.